Hi class, Dr. Mark the Shark Smith again, wanting to discuss P&L. We're heading into week 4, so wow, is it going fast. And just wanted to get this information out to you. If you need it, let me know. And of course, I'm always available for our designated class times to answer any questions, concerns, and be around if you need me for anything at all times. So today we'll talk about P&L. So P&L, it's profit and loss, it's income statements, it's got a bunch of different acronyms and names to go along with it. So don't be scared of it. It's not as scary as it seems, P&L, right? Look at me, look at me, look at me now. It's fun to have fun. Is it fun to have fun? But you know you have to and how. So if when it comes down to P&L statements, the easiest way I can say it is we need to know you need to know this information and you can't walk away from it. No matter if it's something that you have to do regulatory wise, if you're working for a publicly traded organization, or if you're a startup company, just wanting to understand how your net profit and loss is working in a nutshell. You need to know these things. Now, income statements, P&L, or the various other acronyms companies like to use are going to look very, very similar and always have the same information on them. Just different categories, different segments, and different setups. But it's going to have pretty much an income area where you look up here, you have your gross sales and net sales, which is this. You're going to have any other income from sale of assets, from income on interest, from credit lines coming in, from people giving you money, financial stuff, whatever. That's all going to come in as an income portion of it. Now, these in the middle are all going to be your expenses. All right. So typically this one's broken up to show net sales versus cost of goods sold, or COGS, as we've talked about prior. Now, beginning inventory, add purchase freight, labor costs, inventory available, blah, 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 cost of goods sold. So this is the cost that it takes to make the goods and services. This is the overall sales. So this would make your gross profit based off of how much it costs for you to make your stuff and how much you actually sell. So you have your gross profit here. Now we have to go through your expenses. Ooh, and this is actually a small list, but they can get very, very, very granular, very, very nuanced, because advertising can have up to 100 different segments to it. Bank charges, all these other things can have a whole bunch of other subsidiaries to give you very, very more and more detailed information on exactly where they're all going to go, which you should eventually want to look through, because if you're trying to cut down on expenses, just simply crossing one of these off or saying that one needs to go less is not really much of a clean depiction of what needs to happen. It's pretty ambiguous and not helpful at all. So now, total expenses, you add all these up and you have total expenses, and what you get is a net operating income, because you take this dollar amount, you subtract it from this dollar amount, and then now we have a net operating income. Now, to get our net actual income, we take over any other incomes that come in and we add those to the dollar amount, and then we get what our net income slash loss is. So again, this is all the money coming in, this money's coming in, these are all expenditures, and they've all been broken up to give you very specific information and numbers based on certain things. Net operating income is everything after cost of goods and expenses. That's why you have that. It's a dollar amount that you might be curious about, because the other incomes might be from a bank loan, a credit line coming in, an investor. Like, that's not real income you want to gauge against, because it's not money that's continuously going to come in. So that might be something. Then that overall income might be skewed because of this additional income from asset sales or influx of cash or something of that nature. So you got to be very cognitive and careful about that. Gross profit here just gives you a very clean depiction of how well you're doing before your expenses come up. So if you notice as you're looking at this information that this dollar amount looks really good, but all of a sudden you have all these extra expenses that drop this down to a significantly lower amount, then you know that there might be an issue within your expenses that's causing you to have an issue, because your very rudimentary revenue stream in your cost of goods is making a very high gross profit, but for some reason you are losing track of your expenses and they're getting out of hand, and you're paying way too much in here to make an actual net income. So that's all this does, is give you a lot more of a snapshot to understanding and pretty much doing a better diagnostic skill set of what exactly is going on in your world, of your business, your company, whatever you're doing. All right. So what is it? It's basically also called income statement. It's based on simple formula. Sales minus cost equals profit. Like I just kind of went through very rudimentary. That's it. It's not anything crazy. It's not anything drastic. But why it's important is it needs to determine by tax liability, because the higher amount of profit lines and income, that's going to equate to taxes. Not to mention the types of income that you have might have different tax proprieties against it. So like if there's an influx of like a bank loan or things of that nature, all that's going to change the obscurity of how the tax law and tax work. If you want a bank loan, it's important they need to see that information because they're going to go off of your operating income, not just if you have infused from selling assets and things of that nature. It's your guide to making decisions regularly in your business. Like I said, that allows you to get more diagnostic and get a little more in depth in exactly what's going on with your company, and it gives you a direct health report of how your organization is doing. Now, different worlds, still same thing type thing. So sales could be called revenue or income. Costs could be called expenses. Profits are usually called net income. They're all the same thing. Sales, aka profit, aka revenue. It seems the line between the two, but sales, service, other revenue, selling old machinery, tax refund, one-off incomes, these are all revenue streams. And you can break them up or you can keep them all lump sum. It makes no difference. It depends on how you specifically organize your P&L or your income statement, all right? But the best practices is to kind of break them up a little bit so you have a better understanding of exactly where these incomes are coming from and what they are. And then costs or expenses, those can be cost of goods sold, software, inventory, salaries, pretty much anything that you have to outtake from your profit lines to pay things, whether or not it's a note, a bank note or a credit line, or if it's paying off something of that nature, legal fees, whatever it is, all those different things are going to be played with expenses. This can be operating, salaries, insurance, tax, marketing, whatever you have to pay for, vending machines, doesn't make a difference. All of it's going to matter, all right? And it's all going to take place and go into that context of it. Ta-da! That's it. That's how easy it is to work. So let's kind of test your knowledge a bit. All right. So I just want to show you. Sale of an old laptop is considered revenue. Interest earned off idle cash, revenue. Paper for an office copier, that's an operating expense. Salaries for game designers, cost of goods sold, expense. Storage unit for extra product, cost of goods sold, an expense. All right. So anytime money goes out, it's an expense. Anytime money comes in, for whatever reason, way, shape, or form, revenue. It's pretty easy, pretty rudimentary, and pretty simple. And it works off of the balance sheet as well because you have assets and liabilities. And a lot of those assets, if you sell them or work off them or they create a revenue stream, they go into the profit lines or the revenue lines of the P&L or the income statement. And then liabilities, there's anything you have to pay for as far as credit cards, bank loans, machinery, leases, things of that nature. Those are all going to be considered expenses that you have to pay for. So next time, depreciation and amortization, some tax expense and balance sheet stuff we've already discussed, but we'll kind of go over a little bit more. So enjoy. Very quick and easy rudimentary. One of the videos that you'll see through week 4, and enjoy. Have a wonderful day.